11:05 a.m. Do you know where your home equity is? Welcome to the Velocity of Money. Here now to answer your questions about real estate, capital, equity, funding, and finance, your host of the Velocity of Money, Michael J. Barnes.
Welcome back to the Velocity of Money. This is Michael J. Barnes in studio with us today on this fine New Year's Eve is Dan Havey, the co-founder of the Modification Hotline, as well as the author of the Foreclosure Sharks, a great white paper he put together. He's also the author of Real Estate's Future, and we're talking about this segment here about loan modifications and some specific information. You've also got a great story that you need to tell about this too.
Well, I have. Unfortunately, I have too many stories about people who have had to go through foreclosures, bankruptcies, loan modifications. The one story I want to talk about real quick here is another friend of mine who, unbeknownst to me, went out and did a loan modification on her own. And not to get into a whole bunch of technical details on it, but she ended up getting a pretty decent interest rate because they actually cut her mortgage payment in half, and she was pretty happy about that. She owed a little bit more than what the house was worth. She wasn't terribly upside down, but by the time they got done with her, she certainly was going to be, because the modification that they had, and actually I shouldn't call it modification, I should really call it forbearance agreement. What they did to her is they said, okay, we'll cut your interest rate in half, we'll cut your monthly payment in half, but what we're going to do is we're going to take all that deferred interest and we're going to tack it on to the back end of your loan, so that by the time that her interest rate went back to where it was had been, which was it was going to actually adjust up over the next 5 years, so that within the 5-year time period, she was actually going to owe $60,000 in back interest on top of the principal balance that she had before she went to go talk to her bank.
What kind of a deal is that?
I didn't think it was a very good one. She ended up eventually not taking it, and just recently let the house go back to the bank, because she just looked at that and said, wait a second here, I'm already $20,000 upside down. By the time I'm done with you guys, I'm going to be $80,000 upside down. And so great, I get a cheaper payment, but she moved into a rental property that was still even cheaper than what she was going to have to pay to stay in this house, and what she tells me, the house is nicer.
Huh. Well, that's some of the unfortunate scenarios that come up that we get to see. Unfortunately, we talk to lots of people that have similar situations, try to do these things on their own. And it is possible to do a loan modification on your own. We know that. The program is designed for you to do that. The problem is that it generally doesn't work out. The re-default rate on loan modifications done on your own is significantly higher than loan modifications facilitated by an attorney that's representing you for, I would imagine, a number of reasons. Number one, you have to pay an attorney to represent you. The other, I think, is that you're going to get a better modification based on real factors, not just a negotiation between you and an expert negotiator in the loss mitigation department for the bank. We're talking about using a professional attorney who is a trained negotiator to negotiate on your behalf. With another attorney, by the way. They're not talking to the same loss mitigation people in India that you may be talking to, correct?
Right, and here's some numbers that just came out from John Dugan, who's the Office of the Comptroller or Comptroller of the Currency. And they did a study of the loan modifications that have been done to date. Now, again, I keep saying loan modification, but in many of these cases, these were actual forbearance agreements. So again, if the individual talks to his bank, generally speaking, he's not going to get the same thing as what an attorney would do. So most of these really were forbearance agreements. And in that case, 36% of them had defaulted or were 30 days past due after 6 months, and 58% of them were in default after 8 months. That's 58% after 8 months. And I saw some numbers the other day, and unfortunately I didn't bring them in with me today, that according to some study, that the very few, unfortunately, very few modifications that have been done using an attorney, Now I say very few, but it's still thousands and tens of thousands, but not compared to what's getting done directly with the bank. It's like the number is only like 5% of the ones done with an attorney have re-default. And again, I don't have the numbers with me, so I can't cite the source today.